Dear students, I have come with a new module. This is our module 5, and in this module I will explain capital receipts versus revenue receipts. So that's an important topic in income tax. What treatment we are giving for capital income, what treatment we are giving for this revenue income or expenses, it's totally different. So what are the reasons for this change, or why we have to distinguish between capital and revenue? So we are considering one aspect here, capital receipts and revenue receipts. Capital losses and revenue losses, capital expenses and revenue losses will be considered as next modules. In the next modules we will be covering those topics also. So the three topics what we have to decide. One we are going to explain now, capital receipts versus revenue receipts. So first topic what I will do here, what are the reasons for distinction between capital and revenue for income tax purpose? What is the reason? First is fundamental principles of income tax. Income tax, I told you there are 5 heads of income: salary, house property, business or profession, capital gain and income from other sources. So capital gain, that head of income, is specifically given for capital receipts, and other 4 heads of incomes are for revenue items. So we have to distinguish between revenue and capital for fundamental principles of income tax. Then only we can calculate the accurate profit and pay the tax properly. Second is impact on how incomes and expenses are treated under income tax. So income and expense. See, if it's capital, I told you it will coming under capital gain. If it's revenue, income or revenue expense, it will come under other heads of income. So the proper treatment is different, especially when we are doing the income from business or profession. This distinction is very important to get the actual profit. Third is correct computation of taxable income. Taxable income. If you are not calculating the correct taxable income, we will not be paying the correct tax. Tax avoidance, and the government will not get the actual tax what we are supposed to pay. Next point is prevention of tax avoidance. Tax avoidance, you have to remember, if you are not paying the correct tax, people will not pay the tax at all, or sometimes they will pay less tax than what they are actually supposed to pay. So these are all the problems associated with not distinguishing between capital and revenue items. The next point is proper classification ensures compliance and fairness in the tax system. Whenever we are talking about the income tax or fairness in the accounting system, tax system, these are all very important. We have to be honest citizens and we have to be paying the correct tax. Next is proper application of depreciation rules. Depreciation, we are allowing for capital assets. We have to remember, when we are doing the profit and loss account and balance sheet, we are charging the depreciation for the use of the asset. So that will affect the profit or loss of the organization. So it's very important, the depreciation rules we have to apply properly. Then fair reflection of business profit. Business profit. If we are following the correct accounting principles and taxation principles, then only we will arrive at the correct profit. Then compliance with tax laws and judicial precedents. So that is very important. Tax laws, it's very important. Tax laws and the important decisions, judicial decisions we have to consider. Next point is correct classification for capital gain. Capital gain, I told you, that's the 4th head of income, capital gain. In that we have long-term capital gain and short-term capital gain. If you want to distinguish between long-term capital gain and short-term capital gain, it's very important because set off carry forward rules are different for long-term and short-term capital gain. So it's very important, it's important that we have to classify that properly. Then impact on carry forward of losses. Set off and carry forward. I told you that when long-term and short-term capital gain or long-term capital loss and short-term capital loss are distinguished properly, then only we can assign the correct rules for carry forward and set off of losses. So these are the reasons for distinction between capital and revenue for income tax purposes. We have learned 10 points. First is for the correct income tax rules. Second is to find out the correct income and expense. Third is to calculate the correct taxable income. Then avoid tax avoidance, fairness in the system. Then apply the correct depreciation rules, to calculate the correct profit, to apply the correct tax laws, to calculate the correct capital gain, whether it's long term or short term, then to apply the carry forward loss and set off and carry forward rules in income tax. Now the second topic I want to explain here is the distinction between revenue and capital items. I have put it as a table. If it's taxability, if we are talking about taxability, first is revenue, second is capital. So if it's revenue, tax if it's an income and allowed as a deduction if it's an expense. Whereas capital item, it may be taxed if it's a capital gain but cannot be allowed as a deduction. So here income and expenses both are considered. Here it's only gain. The expenses are not considered. That is the first distinction. Second is the accounting treatment. Accounting treatment, we have to remember, if it's revenue, it appears in the profit and loss account and balance. It appears in the profit and loss account. If it's capital, it appears in the balance sheet. Now the third point is depreciation. Depreciation, in the case of revenue items, not allowed. Here it is allowed. Fourth point is impact. What is the impact? This will affect the profit. Revenue treatment will affect the profit. Capital will affect the capital structure of the business. This is the capital structure. So the 4 points, that is distinction between revenue and capital items. One is taxability. In the case of revenue, we are considering both income and expenses. In the case of capital item, we are considering only capital gain. We cannot allow expenses as a deduction. Treatment, revenue items, profit and loss account will be affected. Capital items, balance sheet will be affected. Depreciation, for revenue items, it's not allowed. Whereas for capital assets, it's allowed. Impact, revenue, if you are giving wrong treatment, it will affect the profit and loss account. Whereas capital, it will affect the capital structure. Now we will come to the third point. Third point is criteria for deciding between capital and revenue receipts. First is amount is received in lump sum or installments. This is an immaterial whether we are getting 3 months salary at one time or we are getting monthly salary. Both are considered as revenue expenses. So it's immaterial whether we are getting as lump sum or whether we are getting every month. Second point is nature of receipt in the hands of the recipient. It is imperative to identify the source from which the payment is made. Sometimes salary is paid out of capital, but we have to remember it's still a revenue expenditure. It's not a capital expenditure. Next point is magnitude of receipt. Magnitude of receipt. Magnitude of receipt. Magnitude of receipt cannot decide whether it's capital or revenue expenditure. For example, maybe 10,000 we received. That can be a revenue item. But for 1,000 rupees we received, it can be capital expenditure. So the amount cannot be the deciding factor for capital and revenue. Next is name given by parties in the accounting treatment in the books of accounts. We know that they have the option. Different types of accounting treatment they can follow. January to December, Diwali to Diwali, New Year to New Year, like the calendar year, different types. But whatever the name they are giving, we will not consider. We will apply the principles. So this cannot be the criterion for deciding between capital and revenue receipts. So the character of the receipt will be decided by considerations rather than name given by parties. I can receive a consideration. Even if it's revenue, I can call it as capital. It is not possible. We will see the actual rule. For example, a capital payment made by dealer can be a revenue receipt for the recipient. Already explained that. Imagine a firm going into loss. They don't have revenue income to pay the salary. So they may be paying out of capital. but still it will be a revenue expenditure. Next is payment made out of capital. So it is immaterial whether payment is made out of capital in deciding between capital and revenue items. So this point we have explained again and again. I will explain with one question. A company owns a cinema hall and receives compensation from the government because it's forced to permanently close its business to make the way for a new public project. That meaning it's permanently closed. So the compensation what we are receiving will be capital. Whereas the second option, if it's closed for 3 months for metro construction, it will be a revenue income or a revenue receipt. The reason is it's temporary, whereas the first one was permanent. Now next is time of receipt. Time of receipt refers to when the money is received and in some cases why it is received at that particular time. Example, a cricket player, 2 options we are giving. First one is he is getting 50 lakhs for signing a 3-year contract with a sports company. So one time signing fee, it will be capital. It's one time. Whereas for one match he is getting 10 lakhs as compensation. Maybe the best player or something. Then it will be a revenue receipt. Now quality of receipt. The quality of receipt refers to character or nature of the income received. That is what the payment is really for. Example, manufacturing business sells an old machine for 5 lakhs. So this will be a capital receipt because it's a machine, it's a capital asset. Same, imagine the second option, the same business sells stock in trade for 5 lakhs. That will be revenue. Stock in trade is the circulating asset. Now, last topic for this, nature of asset. Capital asset or circulating asset. We have to distinguish between, see the earlier example, I have given that capital asset, stock in trade is a circulating asset. Anything related to circulating asset, it will be a revenue item. Anything related to capital item, it will be a capital receipt. Termination of income. Similarly, termination of income you have to remember. Permanent termination of income, it's capital. Whereas if it's temporary, it's revenue. Example, amount received in substitution of income. A company was an exclusive distributor for a multinational company. Due to a policy change, agency contract was terminated and received 20 lakhs as compensation for the premature termination of the agency. It will be a revenue receipt. So this points again, compensation received in termination of lease. A factory owner leased out land to a company for 25 years. After 10 years, company terminated the lease early and paid 50 lakhs as compensation. So here you have to remember permanent closure, it's a capital receipt. Next is compensation or surrender of a right. That is, if it's right to earn an income like an agency, license, etc., compensation is usually revenue because they are going to use that in the continuation of the business. Then if it's a capital right like leasehold interest, mining right or franchising, compensation is usually capital. Now purpose of keeping an item. If the purpose is to keep the business over time, it is capital in nature. For a number of years if the business is using, it is capital. But if the purpose is to set or consume during business operations for 1 year or 2 years, it is always revenue. So this is what I wanted to explain in module 5. Hope you got a difference between capital receipts and revenue receipts. First we have seen what are the reasons why we have to distinguish this. Then the distinguishing 4 points I have explained. What will be the criteria? Why the distinguishing points, 4 points we learned. Then we learned the criteria also with examples. Happy learning. Thank you.